Dear students, today we are going to see the introduction of financial economics subject. Financial economics is a branch of economics that analyzes the use and distribution of resources in market. Financial decision must often take into account future events, whether those be related to individual stocks, portfolios, or the market as a whole. So, getting into the definition of financial economics, it is the study of the preferences of investors and how they impact the trading and pricing of financial assets like bonds, stocks, and mutual funds. So, most of the decisions are based on two things. So, the two main investor preferences are high rate of return and the least amount of risk and uncertainty as possible. So, what we do in financial economics? In financial economics, we analyzes the use and distribution of financial resources in market. So, we employ economic theory to evaluate how time, risk, opportunity cost, and information can create incentives or disincentives for a particular decision. So, financial economics often involves the creation of sophisticated models to test the variables affecting a particular financial decision. So, before getting into the theory of financial economics, you should know the difference between financial asset and real asset. So, financial asset include usually the stock, bonds, mutual funds, and real estate. Real assets help companies to generate revenues and are important because they have an intrinsic value related to them. And again, if you see what is real asset, they are divided into two parts known as tangible asset that have a physical form such as machinery, all those things, and intangible asset, they do not have a physical form such as copyright, patent, etc. Coming to financial assets do not have any intrinsic value of their own, but they represent another underlying asset that has some value. The financial asset, a monetary value, can be obtained unless it is converted to cash. Example of financial assets include shares, bonds, debentures, etc. So if you see the major difference between real asset and financial asset, real assets usually represents a society's wealth. Financial assets are claims to the income generated by real assets. And again, coming to real asset produce output consumed by economy. They determine the productive capacity of the economy. For example, it includes land, building, machinery, equipment, and knowledge. But financial assets are just pieces of paper or computer entries. They contribute to the productive capacity indirectly. They do contribute, but their contribution is an indirect contribution. For example, stock, bonds, etc. So these are the major differences between real asset and financial asset. With that, we will finish uh, uh, today's class.